Good morning, everybody. This is the live market open for Wednesday, August 31st. It's the last day of August, the last day of vacations, and tomorrow, September 1st. So things are getting busier. I'm Yohay, Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. And today, as usual, we'll cover recent developments in markets. We'll do the charts and levels section, this time with a bit of a wider focus for September. Okay, support and resistance levels for 10 different pairs. We'll focus on one currency pair, the Australian dollar, which is an interesting situation. Continue with the preview for the non-farm payrolls, which became much more interesting after Jackson Hole. And of course, a preview for next week's events. As always, your questions are more than welcome. I see someone with the letter L here, and I hope to see more people in the chat and have your questions. In any case, if you cannot see the chat box alongside the video, please go to the address here, tlk.io/fxstreet-forex-live-video. Okay, let's begin. What's going on in markets? So, in Jackson Hole, we had Fed Chair Janet Yellen telling us that the case for rate hike has strengthened. Okay, so this at first supported the US dollar, and then we heard, on the other hand, that of course, it's data dependent and things like that, so the dollar weakened. But then came Vice Chair Fischer, and he already said that clarified, if you wish, what Janet Yellen said, and said that what she said is consistent with the rate hike in September. That means there is a better chance of rate hike. So the dollar went much higher, and then that's what we're seeing until this day. So we're already on Wednesday. The event was on Friday. Okay, but here are the headlines. I mean, the dollar shot higher, and it became, and the gains were sustained. The gains also went into the new week. Okay, now it isn't a risk-off move. It isn't like, it isn't the case where the dollar is strengthening against all the currencies except the yen, and the yen is weakening. Okay, sorry, the yen is strengthening, but the yen is weakening also against the US dollar. Okay, now we always know the Fed is data dependent. Well, their forecasting powers are not as good as they used to be. So this makes the non-farm payrolls on Friday even more important. Okay, so this was a really big event. I must say it beat my expectations. For those of you that watched the show last week, well, you can still re-watch it. I was skeptical that she'll say anything meaningful. She said a bit, she was quite cautious, but then she got sort of another boost from Fischer. And even though he's known as a hawk, the vice chair still had his impact because he clarified what Yellen said, not said what he personally thinks. Okay, so for now, this rally is holding. So fear of a rate hike is taking over. Other things going on in markets. Some traders have ended their holidays, but not everybody. Okay, so there was a bank holiday in the UK this Monday, and there's a bank holiday in the US next Monday, and it's a Labor Day weekend. So some are back, well, the end of August, the beginning of September, but some are coming back only at the first week of September. So remember that volumes are thin. Well, they're getting, trading volumes are rising, but still not at their peak. Another thing to watch out for, today is the last day of the month, okay? As you know, when we have strong movements during the month, we sometimes see corrections because portfolio managers need to sort of tidy up their books towards the end of the month. So we might see this happening now. That means that close to the London fix at 4 GMT, you can see some last-minute movements. 3 GMT, some last-minute adjustments, and these may not stick, okay? So I don't know which currencies are going to benefit, but I can tell you that in these situations, we see sort of the last-minute moves, sometimes breaking technical lines, but don't take it too seriously. Things will get back to line afterwards, okay? Another thing on the agenda is that Brexit is returning to attention after the summer. Today, there's a cabinet meeting in the UK. New Prime Minister Theresa May and her ministers will be meeting. And we still don't know. She always says Brexit means Brexit, but what does Brexit actually mean? We don't fully understand if it means retaining access to the single market. European Union, that means accepting free movement, but that's not what the Brexiteers want, or closing the gates to Britain, but that means also less economic activity. So maybe we'll hear some news today after this cabinet meeting. Maybe we'll be left in the dark. Okay, so we talked about Jackson Hole, which really dominates the figures. Let's talk about other data that we had. Well, on Friday before Jackson Hole, we had US Q2 GDP downgraded to 1.1, exactly as expected. Very poor growth, okay? So this sort of contrasts the hawkish tone, but that's poor growth for Q2. Q1 was also poor, and also Q4 was weak, but Q3 already looks much better. Expectations are for an annual growth rate of about 3%, okay? And we got some confirmation for the optimism for a second half or Q3 turnaround, because durable goods orders for the month of July, they jumped 4.4% on the headline figure and 1.5% on core, better than expected in all measures. And these are long-term figures, investment, so it looks good. Okay, also US existing home sales, they were just okay, but new home sales, which are more important, last week they were good. The core PC price index released on Monday was as expected. So this is the weaker part of the Fed mandate. Remember, the Federal Reserve has two mandates, jobs and inflation. Jobs are looking good. Well, we'll learn more about that on Friday. We'll do a preview for that later on. Inflation looks very, very stable, better than in Europe, better than in Japan, but still 1.6% core PC, the figure that the Fed watches most, not going anywhere fast. But yesterday we had the US CB consumer confidence. It came out at the highest level since September 2015, almost a year. So 101 points. So that was good news. Okay, before we continue, I see a question here by L. Asks, sorry, when is the UK cabinet meeting scheduled for? Today? Yeah, by the way, UK data coming on the brighter side, yeah. I don't know when the meeting is scheduled for. Don't follow. I'm not sure we'll get really market-moving headlines out of that. Just a story that was a bit in the background because of vacations, and now it's coming back. And indeed, your point is very correct. UK data has been positive. So initially, after Brexit, we had a few bad figures. We had, you can see me better now. We had, well, these were soft data, purchasing managers indices, all kinds of the BRC surveys, CBI surveys. They pointed to a significant slowdown, especially in the housing sector, okay? But these are surveys. Then we got some hard data. What people actually did, what happened in the economy. So jobless claims were down, and that's great news in July, after Brexit. And more importantly, retail sales jumped higher. So they said, oh, okay, it's just a function, it's just a result of good weather. But if weather has an impact, I mean, has the primary impact and not Brexit, that means that Brexit does not have such a strong impact. So indeed, the data was positive. It helped the pound recover. What we're seeing now in cable, in pound dollar, the slide is totally related to the US dollar and not to the pound. So for the pound, it's more of a wait and see mode. So the pound was hit hard by the Bank of England on August 4th when they cut interest rates, added more QE, and painted a gloomy picture in general, basically not ruling out the chance of a recession and hinting about another rate cut probably in November. But then we got the positive data, and we had a recovery in the pound. Now we're waiting for more data, waiting to hear from the government. When will they trigger Article 50? In general, situation so far is not so bad. And we've seen the soft data, and we'll see it a bit more later this week. We've seen it recover. So the mood has improved in the UK because the actual data has not been that bad. The best analysis that I've read about it, I think from Larry Elliott, the economics editor of The Guardian, he said that, okay, so far it doesn't look that bad, but the UK economy could still slow down, but it will not be a car crash. It'll more be like a puncture. So maybe not an outright recession, but a significant slowdown. It'll be much more slow motion. Okay. Hi, Luca. Okay, so it's Luca. Okay, good to see you here. Okay, let's continue. So I hope this answers the question or refers to the topic you asked about. Okay. And more data that we had in other places. Well, UK GDP was confirmed at 0.6 quarter over quarter. This is Q2. It doesn't really matter for now. Well, again, it joins the picture, the positive picture that we had in general of no, things aren't that bad. Japanese inflation does look bad though. Outright deflation on the core Tokyo figure, the national figure, and it is positive, plus 0.5 in the BOJ number. All the numbers, all the inflation numbers from Japan came out below expectations. The Bank of Japan is clearly losing the plot over there, okay? Another disappointment came from the German IFO figure, came out at 106.2. It was in contrast to the improvement in the ZOO figure. So it is a bit worrying because IFO is Germany's #1 think tank. And it seems that the German economy, after taking it easy in July after Brexit, in August, German investors, German industrialists are a bit more worried, okay? So it hasn't moved the euro too much. Again, the US dollar is the dominates trade in the euro and in the pound and other currencies. It's something to watch out for. And inflation figures, today we get the inflation figures from the whole continent. But yesterday we got them from Germany. In Germany, it was disappointing. The HICP year over year was minus 0.3. Okay, sorry, plus 0.3, lower than 0.5 expected. On the other hand, in Spain, where I'm living here in Barcelona, and today we have here in Spain the debates about inauguration of a new government. Probably will fail today, and maybe it will fail also on Friday. Anyway, inflation came out better than expected, and Spain was one of the countries suffering more from deflation. So a mixed bag of inflation figures, but we'll get more later on. We'll talk about the events that come later on today, later on this week. But first, we'll move to the charts. For those of you focusing on technical analysis, I guess this is the part you've been waiting for, and this time we'll look at the bigger picture, okay? So this is our segment of support and resistance lines for 10 different currency pairs. Let's go to the charts. Okay, we'll begin with the classic, the world's most popular currency pair, euro-dollar. So this is a daily chart of euro-dollar. Currently, at the time of our show, 111.40. It has support at 111.30. This is sort of weak support. In the past, it worked as some kind of separator. More significant support is here at 110.50, which was a line the pair bounced off just in the beginning of this month, beginning of August, okay? And further below, we have 109.50, which was support sort of post-Brexit, not the immediate post-Brexit, but more at the end of July. And further below, we have 109, round number, which was the immediate swing low of June 24th of post-Brexit, okay? These are the three lines I'm watching. I mean, big lines. Further below, we have 108.20, a line that was touched back in March, and 107.10 as significant line of support. Resistance. Some resistance is at the post-Brexit high of 111.90. Well, since then it was broken, of course, but it was the first high. And it's followed by 112.40, which was the initial high after this post-Brexit high was broken. That's a line dating back to August. And then we're looking here. Well, it's a bit busy, a bit more choppy. 113.50 and 113.70 as highest lines we've seen so far. Above these lines, we have lines seen before Brexit. That's 114.20, actually at the night of the referendum, and 114.60, more of a historic line, not that strong as it used to be. Further above, the high of 2016 is 116.16, and 117.12, the high of 2015. So these are your technical lines for euro dollar. Let's move to pound dollar, to cable. I'm seeing a problem with the refreshing here. Anyway, cable, of course, has fallen quite a lot since Brexit, and we're currently at much lower levels than we used to be. We're still at the lowest levels in since, I mean, the bigger picture since 1985, of course, above the lows, but not gone very far. So this is the big fall seen on the night of the referendum. We touched 150 and crashed all the way down. Okay, so we're not going to talk about all the lines back here that were very relevant until June 23rd, the day of the referendum, but let's focus on the lines that we've seen in recent weeks, in the past 2 months. So immediate support at 130.16. We've seen this line work here at the end of July. Further support is at the round number of 130, although it's quite weak. I didn't even put it on the chart. Further support 129.50. It separated ranges in the past, and now further support is what I call the lead sum line, the low that the pound is seen just before we learned that we're going to have a new government. So lead sum was the candidate that ran against Theresa May. Okay, so that's another line of support, and the 31-year low. About a few days after Brexit is 127.90. Okay, on the upside, so we have quite a wide range here to move around. 113.70 is resistance. It was resistance in the past few days during the month of August. It's followed by 113.60, which capped cable the beginning of August. It's followed by 134.80. When we learned that the Bank of England is not so bearish, well, at one point, this was the high. Okay, it's also the post-Brexit high. Of course, well, closely followed by 135. So these are the lines I'm watching on cable. Of course, if we have a run, we can break to round numbers of 140 or to the downside to 125. But so far, we're seeing a much more limited range there. Dollar yen, here we are, 103.20, so quite a big rise in the past few days. Not only the strength of the US dollar, but also speculation that the Bank of Japan will do more, even though there are contradicting reports. So in any case, 103.40 is not only the current resistance line, but it capped the pair also at the beginning of July. It's followed by 105, okay, round number. Eyed by the Bank of Japan, eyed by investors. Not exactly a technical line, but more a psychological line. 106.40 is already a technical line after it supported the pair on its way down, followed by 106.90, which provided support when the pair was trading on higher ground. 107.50 was the post-Brexit high. Remember, the yen gained from Brexit because of its safe haven character. And above that, 108.20 is worth mentioning. On the downside, we have quite a wide range here. 102 is some kind of support, but not worth putting a line on the chart. 101.50 is further support. Worked well in the middle of July, followed by 100.80, sort of the last barrier before the round 100 level. Remember, when we fall under 100, we lose a digit. So that's, of course, very strong support. And it's followed by 99.60, which worked as support during the month of August. The post-Brexit low of 98.80 is a very strong line indeed, even though it was a swing level. And I'll mention 97 as another line below. Okay, before we covered three currencies, I see a question here, puzzled by NZD performance of odd and CAD. Okay. Yeah, we'll talk about commodity currencies right now, so I hope it'll answer your questions. So, dollar CAD, the Canadian dollar moves with oil prices, but not always in a straightforward manner. So oil prices did fall. We'll reach oil at the end. That's why the Canadian dollar has been moving to the upside. So some support here at 130.80. Further support at 130, very round number, and also worked the support here in August, well, during the month of August, I would say. Further below 109.10, not as strong as it used to be, but still worth mentioning. 108.30, a line that worked here several times as a bouncing spot here in August and also here in July. So it's strong support. 107.65 replaces 127.65 replaces 127.50 as strong support, the lowest level in over a month, and 126.50 was the low seen back here in June. Of course, it's worth mentioning the round number of 125, which is also 80 cents if you look the other way around, CAD USD. On the top side, we have 131.40 worked as resistance here in July, and then 132.40, which was the high in quite some time. If we look to higher ground, we're already at levels last seen in the spring, so it's 133.70 and 134.60, which is a very, very, very strong line. Canadian dollar is moving in a weakening correlation, but with oil prices. The Aussie, which we'll focus on later on, and the Kiwi are a bit more complicated. Okay, so the Australian dollar failed to rise to higher ground, and what cannot rise must fall. Currently at the very round number of 75. If we fall under this line, we're back to levels seen earlier in the month. So 74.20 is further support, worked as such back in August, followed by 73.70 or 73.75, which in the past capped the pair. Further support 73, which was a line of support here in July, and then when we traded in a lower range, we were between 72.50 to 71.75, and below 71.40 is another line. On the downside, on the upside, we have 75.30, 76, which is already a stronger level, and 76.40, another strong level, and here even stronger, 77.40, lots of 40s here, and the top line is 78.40. We're seeing some kind of uptrend here, but I think it's losing a bit of strength. Kiwi dollar, we had lots of news from New Zealand of late. It doesn't happen that frequently. Anyway, currently we've seen attempts to break higher, quite a few false breaks by the Kiwi dollar. So this line of 73.40, 73.30, look how many attempts to break it were made. So once we reached this line here in the middle of July, then we made it a bit higher, but no cigar, as they say, and then reached a new high of 73.80, the highest level in 14 months. But that was also a false break, and we fell back down. Okay, there might be some kind of intervention, confusing messages from the Reserve Bank of New Zealand. Currently we're seeing some US dollar strength, so we're back to lower ground. So if we go from top to bottom, 73.80, I'm not sure it's a real line, but it's the high for now. 73.40 is the line I'm looking at more closely. 72.60, 71.60, which worked as support for the pair and also as resistance beforehand. 70.50 worked as a double top right here. In the spring, autumn in New Zealand, spring here in the Northern Hemisphere, below the round number of 70, which again, I didn't put a line here on the chart because it didn't work very well technically, but it's of course psychological level. 69.50 provided support for the pair back in July, and 68.80, 68.20 are lines to watch if we fall to the downside. Okay. Let's continue with dollar Swiss. For those of you that don't know me, I don't like the Swiss franc because of ongoing intervention from the Swiss National Bank. In any case, we've seen quite a rally in dollar Swiss, mostly the strength of the US dollar, a bit, so maybe some intervention by the Swiss National Bank, Thomas Jordan and his colleagues. Anyway, 1950 is the line of resistance, seen here also in August, and it's followed by 99, and of course the round number of parity. Okay, maybe, sorry, 99.50 is also worth mentioning. On the downside, we have the round number of 98, a bit weaker than it used to be. 97, also a round number, also not so strong. The strongest line to the downside I'm looking at is 96.40. Okay, and even stronger here is 95.40, and of course 95, another round number. Euro Swiss ranges here are of course much tighter because the Swiss National Bank intervenes in this specific currency pair. Let's start from the bottom. 107.60 used to be sort of a line in the sand for the Swiss National Bank. It's followed by 108. Here we have a much this is sort of within the range already. 108.25, 109, things like that. 109.50, 110. The highest level we've reached is 111.20. Okay, let's continue to more interesting currency pairs. For instance, this specific cross, Euro Pound. Of course, this is the divorce cross, if you wish, the Brexit cross. The UK leaving the European Union, but the currencies trade very nicely. Currently, just above 85, very round number. Let's begin from the top. 87.20 has been the high line. It's followed by 86, which is also, well, a round number and a strong line. Currently 85, which is a round number. 84.30 works as support. 83.50, and then 82.50, which is the sort of line of support after we stabilized from the highs right here. All in all, the trend here remains to the upside. Of course, to the downside, we have the round number of 80, but this isn't. We have a few more hurdles before that, so it's, I would say, 81.20, which has been the high here back in April. Okay, but the key levels for this cross are, let's put it a bit more precisely, 84.80 and 87.20 to the upside. Okay, these are some of these levels are, well, they date back to the time when the pair was trading on higher ground, which is the summer of 2013. Since then, the euro weakened against the pound, strengthened, and of course strengthened quite a lot after Brexit. Okay, euro yen, two currency pairs that are in high use, but not that popular. So currently we're tackling resistance at 115. I mean, they're popular in the real world, but not for Forex traders. To the upside, we have 117, which sort of, well, provided support and some kind of resistance, and 118.50, high resistance 121 and 122.40. To the downside, we have 112.20, which proves itself quite well during the month of August, and 111. Okay, further support here at 109.20, but this is more of a swing low. The bigger picture is, of course, decline. The euro is not, well, it was a temporary safe haven currency, but not anymore for a long time. And yeah, and the yen is the ultimate safe haven currency. Okay, this is pound yen, very popular cross among currency traders, approaching resistance here at 136. Further resistance 139, under the round number, of course, of 140. The high level seen post Brexit is 143.40, so this is key resistance to the upside. On the downside, we have the round number level of 130, but we already reached lower levels at 128.50. All in all, pound yen, many pips to be made, and the same number of pips to be lost. Okay, so trade with care, with low leverage on this specific currency pair. Okay, so we covered all these currency pairs, and now let's just complete the segment with a look at WTI crude oil, which impacts the Canadian dollar and impacts the mood in markets. Inverse correlation with the US dollar, not always there, but in recent weeks it's been there. That means stronger dollar, weaker oil prices, stronger oil prices, weaker dollar. Okay, inverse correlation. Currently $46.18. 45 40 used to be a line of support, but a stronger support at 44.50. So the round number of 45 is not that significant. 43.25 sort of temporarily halted the pair's recovery. Remember, just in the month of August, we've traded between $39 to almost $49, so it was quite a month, 20% gap. Anyway, more to the downside, 43.25, we said that, 42.40, 41, which was the stepping stone before the ongoing recovery. The round number of 40, of course, cannot be ignored, and 39. To the upside, 46.50 and 49 are levels to watch. Even higher up, I don't think we'll reach these levels soon, but worth mentioning 51.05 and 51.60, the high for this year so far. Okay, so this completes our chart section. This time we took a zoom out and looked at the bigger picture on daily charts. Okay, let's continue with the regular show. Today, after the show, immediately we have German unemployment. Labor market in Germany looks great, and that unemployment rate is falling. Shouldn't be a big surprise, not such a big market mover. Inflation figures are more important today. That's because we haven't heard from Draghi in a long time. There's an ECB meeting next week. So inflation numbers will provide more information. In Spain and also in France, things were more positive, but in Germany they were weaker. Let's see how inflation comes out. Expectations are for 0.2 on headline inflation year over year and 0.9 on core inflation. You can blame low oil prices on headline inflation, but core inflation, well, you can't blame anything for that. And we get also today the beginning of the non-farm payrolls hints. ADP NFP at 12:15 GMT. Okay, not always highly correlated. Remember, it's only for the private sector, but it always has an impact. We're expecting more of the same, around 175,000. For those who are trading the Canadian dollar and GDP figures, these are figures for the month of June. That means they conclude the second quarter, so also get the quarterly figure. So it could be in Canada, they release GDP on a monthly basis. It's the only country I know of. Good morning, Ed. So they have, but this time it'll be a bit more interesting than the monthly release. Remember, like with demand, supply and demand, the more you have of an indicator, the less important it is. And pending home sales at 2 GMT from the United States, it's the least important housing figure. All in all, housing in the United States looks good. Oil inventories could provide, well, I would say the currency to focus on today would be Canadian dollar because of the oil release and GDP. Let's see if oil prices are pushed a bit lower. In oil, we had speculation about production cut or freeze in the upcoming OPEC meeting. If we learn from the past, they will not agree on anything, just keep on pumping out more oil. Tomorrow, first day of September 1st, back to school. So we have, it's a manufacturing PMI day, beginning from China. We have the official manufacturing PMI at 1 GMT and at 1:45, more importantly, the independent Caixin manufacturing PMI. Also watch out for Australian Capex retail sales. We'll focus more on that in the Aussie focus. Manufacturing PMI in the UK will give us another indication if the soft data, if the surveys, if the mood among businesses has improved, because we've seen that Brexit is not such a big disaster so far. That'll be interesting for the pound, even though it's not the most important sector. To 12:30 US jobless claims weekly release, another hint for the NFP, not the most important one. The bigger hint is the ISM manufacturing PMI at 2 GMT. And on Friday, of course, US non-farm payrolls. At the same time, the Canadian jobs report, if I'm not mistaken, and factory orders at 2 GMT. But of course, the NFP is the most important one, and we'll focus back on that. Good morning, FX Ambassador. UK will be leaving EU. Well, we'll see. Yeah, good to be back. Anyway, so that's the upcoming events, okay? So now we'll do a segment about the Australian dollar. The Australian dollar is in our focus today because, well, it should have been higher, okay? It struggled to move higher. We had some positive employment figures, GDP figures, but we also had mixed messages from the Reserve Bank of Australia. The mixed messages could be due to the fact that we have a change of guard in the Reserve Bank of Australia in Canberra. So Glenn Stevens is stepping down, and Philip Lowe is coming into his entering his big shoes. Why do I say big shoes? Because Stevens was sort of selected as central bank governor of the year a few times. Sound economy, sound monetary policy, but the messages for the future are unclear. So his successor is someone from within the bank. It should provide continuity, but we're unsure if, on one hand, they're happy with the transition from depending on mining to domestic activity or not, and what they think about housing. In any case, what we're seeing in recent weeks, and I think this trend will continue, that there is a bit more of a detachment between, from the Chinese data and the Australian dollar. So the Australian dollar is a bit less sensitive. Of course, if we have another crash of the Chinese stock market, like we've seen in August last year, as well as at the beginning of this year, we might see another crash, a reaction in the Australian dollar, but we'll also see a reaction in other currencies. So I believe that this detachment of the Australian dollar from China will continue, but you never know what's going on. RBA, again, mixed messages. They're unhappy with the value of the Australian dollar, but not sure they're ready to do anything about it. In terms of events, well, we already began mentioning a few big events. First of all, as I said, Chinese PMIs are a bit less important, so the bigger release for tonight is CAPEX, or capital expenditure. Why? It's sort of parallel to US durable goods orders. It reflects investments, and it's released only once per quarter, not every month. So if the Australian Central Bank, the RBA, wants to see future trends, it looks at investment, CAPEX, capital expenditure, but the numbers could be confusing because we need to separate mining, which is going down naturally. The mining boom has peaked out, and other sectors. So I think it could provide a lot of confusion. Also, watch out for retail sales. Again, domestic demand has been quite robust. Chinese PMIs, watch out for the more important independent one. It has improved, but now it's flirting with the 50 number. 50 separates growth and contraction, so let's see if it falls under 50. My general bias on the Aussie is that it's going down, not only because of the strength of the greenback, but it has been unable to rise, and therefore what cannot come up must come down. In any case, next week we have Australian company profits and the ANZ jobs figure. It's sort of, private sector indicator. And another thing to watch out for, we talked about transition in Australia. We also want to see transition in China. We'll see that in the services PMI to see if China is moving from investment and manufacturing to services and consumption. But the really big event comes on Tuesday. We have warm up with the current account, but then we have a rate decision. So rates have been cut in Australia this year. This time, no change is expected. But it will be interesting to watch what they talk about. I think they'll, on one hand, there still is some kind of a housing boom and potentially bust, especially in Sydney, and maybe they'll introduce more macroprudential tools to limit, demand higher down payments, and perhaps And as usual, they'll worry about the exchange rate. If they introduce more measures regarding housing, that means that they can cut the interest rate, because if you find other ways to curb the housing boom, not interest rates, you can cut interest rates. In many cases, interest rates are raised in order to choke out the housing market. So they might do other stuff. And if they do that, that opens the door for more rate cuts in the future. So I would watch out for that as well. And they'll try to talk down the Australian dollar, but they've proved themselves a bit weak. Well, all the central banks have somehow lost their magic. And last but not least, well, sorry, not last, but after the rate decision, we have on Wednesday Australian GDP. It's the first and final, not like in the US with all the revisions. We have only one release, a quarterly one in Australia. It's the first and final one. Australia hasn't seen a recession since the early 90s. Well, again, thanks to this mining boom. No recession is on the horizon, but let's see how the economy did in the second quarter. A bit late, but still meaningful. And on Thursday, we have trade balance also. It does have an impact on the Aussie dollar. So in the next 7 days, a lot of action is expecting us on the Australian dollar. Again, my bias, showing the charts. Let's show you again. Complete this special segment with looking at the chart of the Australian dollar. So here we are at 75.10. Again, failed to rise. I see this move as more than a correction. Okay, 74.20, 73.75, 73 to the downside. To the upside, if we have a more upbeat message from the RBA, good Chinese figures, more importantly, good capex and good GDP, we could move to 75.30, 76, 77.40. I don't see the pair tackling 78.40. Okay, so my tendency is bearish. My bias is negative, but remember, trade, do your own analysis and check things out for yourself. Okay, so that's our special segment for the Aussie dollar. And now let's do a preview for the non-farm payrolls. So non-farm payrolls is always important, as you know, most important event on the economic calendar. Well, that's historically been that way, and this time it's even more important. So if you were fading this event in previous months, this time it's more important because of Jackson Hole. Janet Yellen said that the case for rate hike has strengthened, but she said it's data dependent. So if we take her words at face value, that means that this non-farm payrolls report is important. Markets are still skeptical of a September rate hike. Let's show you the rate hike odds here. So this is the CME Group's FedWatch tool. According to bond markets, only 24% chance of rate hike. Not that optimistic in September. For November, a week before the elections, more or less the same. After the elections in December, we already have a real chance, 55% of a rate hike. I think those bond market expectations are correct, because I don't think the Fed will raise rates before the elections. Remember, Hillary Clinton is the incumbent. I mean, going sort of for a third term of Barack Obama, and raising rates now will sort of hurt her chances, and she will not like it. Same thing for Donald Trump. Well, not same thing, but he also always said he's a low interest rate guy. And also, I mean, the Fed does not want attention, not from Clinton and not from Trump. I don't see them wanting to draw attention before the elections. I see them as sort of looking for an excuse not to raise rates. Okay, so in my opinion, we'll need a very, very strong NFP report to justify a rate hike. The Fed in general is just dovish. Okay, so even if they move a bit more to the hawkish side, they look for an excuse not to raise rates. Let's look a bit at the expected figures. Two things to watch: the headline figure, non-farm payrolls, and of course wages. Wages at some point early in the year were more important than the headline figure, but after a few months, I mean, April and May were weak in terms of job gains, so we refocused on the headline figure. Now we had a strong June 292,000 according to the revised figure, and also a strong July, 255,000, above the average of around 180 to 200,000. So the focus is back on the headline. I would say maybe they're equal, more or less, okay? So now we're expecting more, not like last time, but more in the general trend, 186,000. Let's see if we have adjusted expectations following the ADP figure, and the ISM manufacturing PMI, and wages 0.2 as expected, which is sort of average. Last time it was above average, 0.3 month over month. I think we better look at the year over year. Last time it stood on 2.6% year over year. We already reached 2.7. I would say we would need, they're equally important. Another thing to watch out for is the average work week. Usually it's very stable at 34.4. Last time it went up to 34.5. So let's see if it goes back down to the normal levels or not. If it stands out, I mean, with the big jump, it could add some impact. Usually it's not a figure we watch out for. The unemployment rate, more important for politics, less important for markets, because we know that any change in the unemployment rate is a result of also a change in the participation rate. So if we have a drop in the unemployment rate, but also a drop in the participation rate, it doesn't mean that much. If we have a drop in the unemployment rate with a rise in the participation rate, of course, it's all good stuff all around. What numbers would we need in order to raise the chances for a rate hike? I would say another jobs report of 250,000. Again, another blockbuster report, a third consecutive month of 250 plus. Of course, no big downwards revisions. And we would need wages to break to another high. That means from 2.6% year over year last time to break above the 2.7% high, cycle high, to reach 2.8%. So if we have 2.8% and above 250,000, I think that there will be much higher speculation for a rate hike. That means that despite the elections, despite the dovish Fed, the data will just be too good for the Fed to ignore it, okay? Of course, there are more figures like retail sales, and we could have any kind of global slowdown, Chinese stock market crash, you name it. Remember, we have 3 more weeks until the Fed decision on September 22nd. But again, to raise the chances significantly, we would need good figures. If we have just an average report, which is good, not bad for the economy, but nothing to rock the boat, I think the Fed will find excuses not to raise rates. That means I think the 200,000 and 2.5% year-over-year wage rises, which is okay, will not be good enough for the Fed to raise rates, okay? And not be good enough, that means for the dollar to continue higher. So we would need a good report to keep the momentum for the US dollar. Momentum of the US dollar maybe will not last that long. And if we have, of course, weaker than expected 150,000 or lower, we could see fall, okay? So that was our non-farm payrolls preview. And now let's do a preview for the week after the non-farm payrolls, the first full week of September. So this is a preview for the week of September 5th to September 9th. On Monday, it's a bank holiday in the US, so we might see some strange movements because of low liquidity, low volume. Labor Day, that's the end of the vacation season. That means that afterward we'll have, from beginning on Tuesday, much more political news regarding the elections, much more trading volume, and much more action. In any case, but we still have some releases. We have, well, that's a mistake. So we have the UK Services PMI on Monday, and this is actually on Tuesday. Sorry for that. So UK Services PMI, most important sector in the UK. Let's see if the soft data again improves. More important than construction and manufacturing. On Tuesday, the aforementioned Australian rate decision. No rate cut is expected. Watch out for any macroprudential action regarding the housing sector. For those trading the Kiwi, milk prices are of high importance. And then we have ISM non-manufacturing PMI after the Labor Day holiday. Usually it serves as a hint for the non-farm payrolls, but not this time. That will be interesting to watch as well. Okay, still important despite not being a hint. On Wednesday, we have the Australian GDP report for Q2, a bit late, but important, released only once per quarter, not like in the US. We have manufacturing data for the UK. It's for the month of July, post-Brexit. Yes, a bit lagging, but still important because it's hard data. And the rate decision by the Bank of Canada. Bank of Canada holds its rates at 0.5 and is not expected to cut rates. Weaker Canadian dollar, of course, assists the Canadian economy to rebalance out from oil. On Thursday, this is already a very, very big day. Chinese trade balance. Let's see if exports and imports continue falling. Remember, don't look at the bottom line figure, look at the top line figures. Less imports, less exports, bad for the whole world. More imports, more exports by the world's number 2 economy is, of course, good news. And the big event of the week is the ECB decision. So today we'll get some inflation figures for that. And then we'll get, the ECB decides. There are also fresh forecasts released by Mario Draghi and his team, inflation and growth. They're not expected to announce new policy measures, but you never know. It's a more important decision than the one in July because we have forecasts. And remember, the ECB QE program is set officially to end in 6 months, in March 2017, and they might announce an extension. So that's sort of a measure that I am more willing to bet on. They want, of course, a weaker euro, but it's hard to get it. Draghi is not the magician he used to be. Also on Thursday, we have the late oil inventories because of the Labor Day holiday. And on Friday, I have to check that out, Canadian jobs report. Yeah, I think it's next Friday, not this one. And the US jobs report to end the week. Of course, we'll be here on Wednesday to preview the ECB and the rest of the events. Okay. Let's see if we have any more questions, and then we'll wrap up the show. FX Ambassador says, Fed is neutral more than dovish. Fed is basically preparing market for December. Yeah, I tend to agree. I think that December has a better chance because it's after the elections, first and foremost, and we'll have enough positive data for the Fed, for the dovish Fed to act. Okay, so of course they deny that they're impacted by politics, but who isn't? So that's how we see things. Okay, so let's wrap up the show for today. All in all, we're seeing a stronger US dollar because of Jackson Hole. Remember, Yellen said that the case for rate hike is strengthened despite data dependencies. We had her words clarified by Fischer saying that it is consistent with the September hike. That makes the NFP this week on Friday much more important. Big events for today. Events we had so far that are worth mentioning. Durable goods orders were positive. Housing figures were good. Consumer confidence was good. So data in the US is also supporting a stronger dollar, but we might see a correction. Inflation figures are coming out today. So far, they've been mixed. In the Eurozone, in Japan, they have been weak. Today's big event, here in the Eurozone, is the Eurozone inflation release at 9 GMT. Okay, this will shape the ECB decision. Big hint for the non-farm payrolls on Friday comes today from the ADP non-farm payrolls. Also watch out for Canadian GDP, which concludes the second quarter. Therefore, it is more important than the regular monthly releases. And of course, oil prices. Remember the inverse correlation between oil and the US dollar. Next up, tomorrow, first day of September, manufacturing PMI day, first day of the month. Watch out for the Chinese one for an impact on the whole world. More soft data from the UK. Let's see if the mood has improved. And ISM manufacturing PMI as a hint for the non-farm payrolls. On Friday, of course, the US non-farm payrolls is the big event, which is worth mentioning. I expect the United States to, we need a blockbuster report for rate hike in September. That means, in my opinion, 250,000 or higher, and wages to rise to 2.8 or higher. If it's only good enough, it's not good enough for rate hike. I mean, if it's good enough for the US economy, for stock markets for an optimistic mood. It's not good enough for the Fed. The Fed will need something that is superb, exceptional. Okay, let's look a bit at the charts. So, a few key currencies. Euro dollar currently 111.35, 111.30 is weak support, followed by 110.50 and 109.50 resistance, 111.90 and 112.40. We're seeing the strengthening of the US dollar as an ongoing trend. The pound is also a bit weaker, but basically in range. Support, 130.60 and 129.30. Of course, the round number of 130 is worth watching. Resistance at 132.70. Dollar yen made quite a move to the upside, 103.25. Resistance awaits here at 103.40. Further resistance, 105. Support, 101.50 and 100.80, and the round number of 100. Dollar CAD, we're seeing the dollar strength, weakness in oil prices, weakening the Canadian dollar. Currently 131, 131.40, 132.40 on the top side, 130 on the downside, 129.10 and 128.30 on the downside. Aussie dollar hugging the 75 level, 75.30, 75.80, and the very high end 78.40. To the downside, 74.20 and 73.75. And the Kiwi dollar, we had a question about that today, had a series of false breaks, currently at 72.45, 72.60 to the top side, 71.60 to the downside is the current range. Currently we're in a bit more stable environment also here. Okay, so that's our show for today. Thank you very much for coming. It's the last day of August. It's been a pleasure to have your questions. Remember, the full show, as well as separate clips from the show, will be available on FX Street and, of course, later on Forex Crunch. Thank you very much for coming. Wish everybody a safe and successful trading day and successful trading month, now that everything is back to full business. And see you next week. Of course, join the next shows on FX Street, join the live coverages, and see you next time. So that's it for today. Thank you, and bye-bye.